Hi everyone, Jessica Morales joined by Nissa Darbonne right now. Nissa, we're going to be talking about the 2019 trends. Hard to believe 2019 is already ending, but if we can look at the private equity trends, really what you've seen this year.
Yeah, so this year there's been an influx of intra-private equity fund portfolio consolidation. The big one will be inter-private equity fund consolidation. That is, big fund A, big fund C, B, D, combining across their portfolios, one-off companies. This one fits with that, but they're in two different private equity firms. That's a much, much bigger hurdle because, you have, territorial type things and who's going to come out the winner. Is it going to be Fund A's portfolio company or Fund B's? But private equity firms themselves, intra-portfolio, have been consolidating operators, and many that I've spoken to this year, increasingly as each month has ticked off the calendar, I'm encountering more and more who would be selling by now. They've put together great assets, plenty of PDPs and plenty of PUDs, the traditional model, but there's just not the market because the traditional buyer has been shut down by investors. So we've had intra-portfolio consolidations within private equity and their expectations to begin seeing those inter-portfolio.
Do you see that continuing into 2020? Or is it kind of just a wait and see as well?
Yeah, at current commodity prices and the current Wall Street investor sentiment towards any additional acquisitions, inorganic growth by publicly held operators. As long as that continues, then yes, consolidation within and among private equity portfolio companies is likely to continue into next year.
What about rig counts? What have you seen there this year?
Yeah, so there's a great deal of lamenting about declines in rig counts. However, operators I've spoken to, many of them, the biggest ones really, with the most rigs out there, they may have started this year with, let's say, 24 rigs, and they are at this point down to 12 or even 10. And one traditionally would look at that as reflecting commodity prices, reflecting a state of industry as being dreadful and poor, but instead they're dropping rigs because they are doing these massive drilling spacing units, DSUs, where they may have 4 rigs lined up side by side, and they're drilling so many wells in that one pad. They're focusing all of their attention to this, and then of course they're going to follow that up with enormous zipper fracs. These are pads with 32 or more wells. That's a lot to work on, and you're doing it with 4 rigs versus having 12 rigs and these focused on these DSUs versus 20 or 24 rigs kind of spread all across your leasehold. So this industry is constantly changing, and I have observed very recently that I think maybe we should stop looking at rig count entirely as a proxy on the industry, particularly at this time while rig counts are declining a little bit. Instead, some of that decline is most likely due to operators drilling these massive cubes, pads, units. Everyone seems to want a different name for them these days.
Let's talk a little bit now about G&A trends. What have you seen there, Nissa?
With G&A, operators are constantly hoping that they're operating with the minimal G&A. I mean, that's just overhead, and that's not adding oil and gas reserves, although the G&A does contribute to that. But it is one means of, kind of making your company look better to investors, making your company look better to buyers. So this year, there was this one operator, for example, that, cut quite a few people, and it has a very large number of employees in the first place, but it was pretty remarkable what their projection for pairing this G&A in terms of personnel will reflect in total savings, and you know, the savings were significant. However, another operator just this morning I spoke to had described how at some point just pairing G&A doesn't do the job. At some point, you know, there are people you need, and the more complicated the rock you operate in, the greater your cost on G&A. So operators are looking at that on an ongoing basis. Clearly, they will begin looking very hard at that after 2014. Many of them, they've cut all they can. They can't really cut much more. But there will be, particularly as there's more pressure amongst companies to consolidate, pairing G&A will be a large factor, particularly as the trend right now is mergers of equals. On a 50-50 basis. There's really no premium associated with it. There is probably tremendous G&A savings there that goes straight to the bottom line.
So it's a lot to have to really delve into and pay attention to there.
Yes.
For each company.
Yes.
Thank you so much for your time and for your expertise on that as well, Nissa.
For more Hart Energy videos, follow our social media channels.